Welcome to the deep dive. We take complex topics, boil them down, and give you, well, a shortcut to being well informed. Today, we're diving into a couple of really specific areas of U.S. tax planning, things that can be pretty surprising. We're looking at below market loans, lending money cheap or free, and also how U.S. folks working overseas are taxed.
Right. And our goal today is really to unpack the why behind these rules. They can seem complex, maybe even arbitrary sometimes. We want to show you the key strategic points, help you optimize things, and maybe avoid some common traps. You should get some real aha moments here, things beyond the basics.
Okay, let's start with those below market loans. So this is when, say, you lend money to family or maybe within a business at zero interest or something really low. The IRS looks closely at these. They worry it's a way to shift value around without calling it a gift or salary, basically trying to avoid tax.
Exactly. And what's fascinating is how they handle it. They don't just say, oh, no interest, okay. No, the law actually imputes interest. It pretends it happened. It's like the IRS creates two fictional transactions on paper. First, they deem the lender transferred an amount to the borrower, the amount of the interest that should have been charged. Now, that deemed transfer could be seen as a gift, maybe compensation, maybe a dividend. It really depends on the relationship between the lender and borrower.
And then this is the kind of weird part. They immediately deem the borrower transferred that exact same amount right back to the lender. And this part is always treated as an interest payment.
Right. It's all theoretical, no actual extra cash moves for these steps, but the tax impact, that's very real for you.
So the big question then is who pays tax and who gets a break?
Well, here's the asymmetry. The lender always has to report that phantom interest payment, the one they theoretically got back, as taxable interest income, even though they never saw the cash. Yeah. But for the borrower, whether they can deduct that phantom interest they theoretically paid, that's not automatic at all. It totally depends on what you, the borrower, used the loan money for. If it was for personal stuff, buying a car, a vacation, whatever, then, that deemed interest is personal interest and it's generally non-deductible.
So let's make that concrete. A parent lends a child money interest-free for, say, living expenses. The parent ends up paying income tax on interest they never received.
Right.
And the child who used it for personal consumption gets no deduction for the interest they theoretically paid.
That's the typical outcome. It's a significant imbalance you really need to know about.
Okay, are there ways around this? Exceptions?
Yes, thankfully. There are some important de minimis exceptions. For most loan types, if the total amount outstanding between the two people stays under $10,000, the imputed interest rules just don't apply.
Okay, $10,000 is a bit of breathing room.
It is. But watch out for gift loans specifically.
Yeah.
That $10,000 exception. It disappears if the loan proceeds are used directly to buy income-producing assets.
Ah, so even an $8,000 loan to buy stock.
That falls outside the $10,000 exception. The imputed interest rules would kick in. It's a key track.
Got it. Any other breaks?
There's another special rule. This one's for gift loans between individuals up to $100,000. In that case, the amount of interest the lender has to report is capped. It can't be more than the borrower's actual net investment income for the year.
Net investment income, like dividends, interest earned by the borrower.
Exactly. And if that net investment income is really low specifically, $1,000 or less, then the lender has zero imputed interest income to report.
Okay, that's helpful for smaller loans or situations where the borrower isn't earning much investment income yet.
Precisely. It offers some relief in those common family scenarios.
All right, let's shift gears. From loans at home to working abroad. U.S. citizens, green card holders, living overseas. You might think, okay, I moved, I'm paying taxes there, I'm done with the IRS, but not so fast.
Not fast at all. The U.S. taxes its citizens and resident aliens on their worldwide income. It doesn't matter where you earn it. So yes, you're still on the hook for U.S. taxes.
But that sounds like double taxation, paying tax where you live and to the U.S.
It could be, but the system has ways to mitigate that. Primarily, two mechanisms: the Foreign Earned Income Exclusion, the FEIE, and the Foreign Tax Credit, or FTC.
Okay, let's break those down. First, the FEIE.
Right. The FEIE lets you exclude a certain amount of your foreign earned income from U.S. tax. For 2025, that amount is pretty substantial, up to $130,000 per qualifying person.
How do you qualify?
Well, your tax home must be in a foreign country. The income has to be earned from services performed outside the U.S., and you need to meet one of two tests. Either the bona fide residence test.
Meaning you live abroad, like local, for a whole tax year?
Basically, yes.
Right.
Or the physical presence test, which is about spending at least 330 full days outside the U.S. during any 12-month period.
And there's something about housing, too.
Yes. You can also potentially exclude or deduct part of your foreign housing costs amounts above a base level, but also capped. For 2025, the base is around $20,800, and the general limit is $39,000, though it can be higher in expensive cities.
Okay, that's the FEIE. What about the FTC, the foreign tax credit?
The FTC is often, well, more powerful for many people, especially those in high-tax countries. It's a direct dollar-for-dollar credit against your U.S. tax liability for income taxes you've actually paid to a foreign government.
So if you paid $1,000 in foreign income tax.
That credit can reduce your U.S. tax bill by $1,000. That's much better than a deduction, which only reduces your taxable income.
Makes sense. Any limits?
There is a limitation, calculated based on your foreign source income relative to your total income. But a huge plus is carryover unused foreign tax credits aren't just lost. You can carry them back 1 year and forward for 10 years. Lots of flexibility there.
So FEIE versus FTC, this sounds like a really critical choice for expats.
It absolutely is. One of the biggest decisions. The FEIE might seem simpler, and it's great if you're in a country with low or zero income tax. Makes sense, right? You exclude the income, pay no U.S. tax on it.
But there's a catch.
There's a strategic consideration. Once you choose to use the FEIE, that election generally stays in place for future years. If you decide to revoke it, maybe because you moved to a high-tax country where the FTC is better, you generally can't re-elect the FEIE for 5 years without getting special permission from the IRS.
Wow, a 5-year lockout. Yeah.
Yeah. The FTC, on the other hand, is effectively an annual choice. You decide year by year whether claiming it is beneficial. Much more flexible.
Are there other downstream effects, choosing FEIE impacting other things?
Yes, definitely. Because the FEIE reduces your earned income for U.S. tax purposes, sometimes down to zero, it can make you ineligible to contribute to, say, an IRA. It can also limit your ability to claim certain credits, like the refundable part of the additional child tax credit, which also depends on having earned income.
Ah, I see. So the FEIE saves tax on the front end, but might cost you benefits elsewhere.
Potentially, yes.
Yeah.
The FTC doesn't have those same restrictive effects on IRA contributions or those credits because it doesn't actually reduce your earned income figure, it just reduces the final tax.
So for higher earners, maybe in higher tax countries?
For them, often a hybrid strategy works best. You might use the FEIE to exclude income up to that $130,000 limit and then claim the FTC for the foreign taxes paid on the income above that exclusion amount. You sort of layer them.
Okay, lots to consider there. So wrapping up, whether it's these below-market loans between family or managing your taxes while working overseas, these rules, they really require you to pay attention. You can't just assume.
Absolutely not. The key takeaway really is that getting the best tax outcome isn't usually an accident. It comes from being proactive, getting informed, and planning based on your specific situation.
It makes you think, doesn't it? How might knowing these details, these nuances, change the conversations you have about money or even your plans for the future? Definitely something to mull over until our next deep dive.